Welcome to Canopy Mortgage's podcast, A Better Way. I'm your host, McKay Shoell. Today, joining us, a second-time visitor, which I'm pretty stoked about, is Travis Meihls. Travis is awesome. I've had the privilege of working with him a number of years. He runs the Consumer Direct division at Canopy, which goes under the label of Box Home Loans. Right, Trav?
Yeah, thanks for having me. Pleasure to be here.
Yesterday was probably a pretty crazy day for you. What is today, October 30th, day before Halloween?
Yes.
And tell me a little bit about, really since COVID, it's been a wild roller coaster in both directions. But tell me a little bit about like yesterday and what the impact of that is, not only for like refinances, and by the way, you can explain what happened yesterday as well, but not only for refinances, but also like what it means for purchasing a home.
Yeah, that's a great question. So it's always impossible to predict, market history. And everyone always asks, well, what do you think? What do you think is going to happen? And we all have our theories and our thoughts, and history repeats itself. There's a good chance that rates will continue on a downward trend, but when that's going to happen is kind of the question of the year. And with yesterday's second in a row federal funds rate cut of a quarter, borrowers immediately think that directly affects their refinance as well as their purchasing power, right?
Wait, when you say directly affects in like a positive way, they think like, oh, rates just got better by a quarter.
Exactly. Hey, McKay, my refinance is 6.125. Am I now at a 5.875? Not necessarily, right? The federal funds rate doesn't directly follow and impact the 10-year treasury, which is what we will follow for mortgage-backed securities. But from a purchasing power standpoint, it does. It does directly affect you in terms of how much you qualify for and how much more home you can now purchase because rates are slightly lower, right? And that kind of comes hand in hand with market movement and fluctuations that we see. But to kind of come full circle, yesterday's announcement, as soon as the media starts to get a hold of the Fed's just cut rates, magically the phones just start ringing, right? You've got borrowers coming out of the woodworks who have been on the sidelines for purchasing a home because they now think, okay, I can get, that much more of a home because my rate's going to be lower. And your refinances who have been paying these high 6s, low 7% rates for the better part of the last 36 months can now capitalize on your lower refinance rate and a lower housing payment. They go hand in hand, but at the same time, what we see in the industry is the market bakes in terms of what the Fed is insinuating and what they're
projecting is
going to do. So oftentimes when the Fed does come out and cut rates, much like what happened yesterday, we actually don't see any immediate impact, right? Because that's already baked into the market 7 to 10 days prior. So that's kind of the conversations that we're having, between last night and today. The market opened up worse this morning than what we quoted borrowers yesterday, which to the average consumer, it doesn't make any sense. Travis, the Fed just cut rates. Why are you telling me that my rate is actually going to cost me more today? Which is just interesting. It's an opportunity to educate people and to help them fully understand our industry and what mortgage-backed securities follow and the implications of the Fed and how different economic data points will come out and change interest rates day to day. We could have a jobs report come out on a Friday, and if that comes in above or below expectations, that'll directly affect us in terms of what rates we can offer in the marketplace.
Okay, so let's say I call you and I'm like disappointed now because I'm like, wait, the Fed cut the rate and you're telling me rates went up between yesterday and today. And I know they did because there was a midday price change yesterday, middle of the afternoon, saying it was worse. So, okay, so now I'm like, oh, well then should I just wait? Or how would you counsel me in that scenario?
Yeah.
And, again, laying the groundwork of I want to purchase a home, not necessarily talking refinance. We might delve into that.
Yeah. So as a home buyer, how I would approach that is there's a cost to doing business in every aspect, right? There's a cost to buying a house at a 7.125 rate. There's also a cost to buying a house when rates are in mid fives. Traditionally, as rates dip, home values are going to go like this, right? So while yes, you as a homeowner are able to secure a lower rate, you might pay $75,000, $80,000 more for that same home, right? The beauty about Canopy being nationwide is we can see what different markets are doing. California is a completely different market than your Florida, and Florida is a completely different market than Michigan. And all of those are impacted by market movement. But as a homeowner, what I would educate you on in my shoes with my experience is if you can afford a home now and you can justify the payment in your head. Everyone wants a $1,500 house payment. Everyone does. Can we have that? Maybe, if we're going to buy a $200,000 house in the right market. But that, at least here in our backyard in Utah anymore, that doesn't exist. Your entry-level homes are approaching $500,000. So if you can justify that payment, I would advise to buy now. And if and when rates do come down, then we capitalize on that refinance opportunity to lower that payment. The Fed's indicated that rates will trend down and there will be future cuts. But again, a lot of that is, we don't know.
Yeah.
That could be Q1 next year. It could be Q3.
And there could be a war. There could be a global financial crisis. Yep. There could be fill in the blank that could either make that a steady big time drop, or inflation and other things could typically or might even go the opposite direction. Who knows?
Absolutely correct. And what we can look back on, and I can spin this around and ask you, McKay, is what did you pay for your first house, and what did it sell for at the time that you sold it?
Yeah, right? No. So it's funny you say that, because I was thinking about, like, if I were on the fence to step in and buy a home right now, like what would I do, or if my son were looking into it, like what would I counsel my son to do? And I remember I bought the absolute peak of the market in late 2007. Right before like the bottom fell out, and I think I paid, it was less than $200,000. It was in Orem, Utah, and I remember thinking like, oh, dude, there's no way I'm going to be able to afford this payment. It was less than $1,000 a month at the time, and then suddenly that house that I paid about $200,000 for quickly became worth like $150 to $160 when 2008 happened, and I said to my wife, like, we're never leaving this house. Like, we're going to be stuck here forever. We're upside down. Fast forward less than 10 years later, I sold it at a healthy gain. And it's really time in market at the end of the day. Like, there will be ebbs and flows, but overall, if you're looking at it, it's like ebbing and flowing, and eventually always going up. And the data, that's not me making it up, the data supports that in most every market. Now, there might be an exception here or there, but at the end of the day, you win if you stay in a long term. Eventually, you will be able to sell it for a profit.
And throughout that decade of ownership with the appreciation, how many times did you refinance the house?
2 times.
Right?
Yep.
So if we look back 10 years, would you have not bought the home? Or would you have continued renting or living with family? Right?
Yeah, no. And unequivocally, I would say my only regret is I didn't get into a home sooner. Like, it took us, I think, 5 years from when we were first married to get into our first home. And my only regret was, like, why didn't I do that 3 or even a year after?
It's very interesting because the data that we have, I can pull reports to show the median age at which my purchase borrowers are purchasing. And I bought my first house when I was 23 years old. I lived with my parents and saved every paycheck that I could to come up with my down payment. But it was important to me that I purchased rather than gone out and rented. And so to kind of come full circle to your question again of what would I advise you as a new homeowner in this market is, if you have the means to purchase, if you have the income, if you can get a gift.
If you can afford it, right? That's what you're saying.
Absolutely.
Yep.
Absolutely. If you can, we don't know what this economy is going, right? We don't know whether 2008 is going to repeat itself or if we're going to continue to see home values increase. But what I do know is, even looking back at Great Depression, stock market crashes, you've got 2008, things will return and things historically do come back even stronger. And specifically, real estate has just this crazy history of the ebbs and the flows, but the constant increase. I mean, there's no doubt in my mind that your $1.5 million houses here will be $2 million within the next decade, Utah. That's just, I mean, I hate to say facts, but that is, if you look at all of the data and you look at, we can talk about inflation, we can talk about incomes. I mean, that may be a whole nother episode here, but what values have done from a real estate stamp historically over time increase, I would always educate my borrowers to purchase now. The rate is important, it is, but at the same time, so is planting that flag and starting to build equity into something that has proven itself out to be a valued asset long term.
Love it. Okay, so switching, and thank you. Bottom line is, to sum up what you're saying is, you would say, if you can afford it, get off the sideline, get into the game, invest in real estate now, get into your home if you can afford it.
Absolutely.
What about, I'm now in my home and I've been there 7 years. I've refinanced and I'm at like 3%. And McKay hasn't been very disciplined, and he's bought a boat and he's bought a brand new truck, and his wife's got a brand new SUV, and I'm totally leveraged. This is all hypothetical. I'm just saying.
So you're living the dream.
I'm living the American consumer dream.
Okay.
I've got some credit cards, but I've also got this 3% rate.
Yeah, you've got a great rate, and I'm sure that the $5,000 in outstanding payments is, paying for itself with that 3% rate. But no, I hear you. That's typically not an uncommon scenario that we come across now, and we're seeing it very often in calls with clients who secured that low rate that they vowed to never touch, right? And then they went out and got the boat and the cars, and those rates are all maybe 7.5%. So we're kind of coming back to there's a cost associated with everything. It's not just the monthly payment that you're paying on that boat, or the monthly payment that your spouse has on their vehicle, but what is that doing for your overall monthly overhead? And it's important that we as loan officers educate these clients and help them get their feet back under them when they happen to feel overwhelmed or in this bubble that they can't get out of, in terms of consumer debt. Consumer debt is at an all-time high. News media is reporting. Everyone can, see it out there.
No, I see it. You look around your neighborhood.
Keeping up with the Joneses is a real thing. And what a refinance does for a client on many levels. You've got your rate and term refinances. You've got your cash out refinances. Cash outs have been huge in the last, 6 months. Home values have appreciated. We're able to wrap in those high interest auto loans, those credit cards. We've seen a lot of student loans that were in deferment, through COVID, and now that individuals are
Now you got to pay the piper,
back
right?
to making payments on those, it all adds up. And incomes haven't increased at the rate that everything else has, right? I cringe. I go to Costco and I look down and it's $400 and I've got 17 items in my cart and it doesn't even fill up the trunk of my car. But at the end of the day, it's still $450. So the refinance scenario is awesome. I love doing purchase business, but I really enjoy refinances. When I can help somebody and not only help them save money each month, but understand the getting rid of the 3% and getting rid of the 7.5%, the 26% credit card that they've been paying the minimum payment on, all for, one payment each month in an asset that historically appreciates, and they understand it, it clicks. And it feels good.
In theory, though, like, well, I'm extending out now my mortgage loan out, but could I take, let's say my net savings on that is $600. Like, you're saving me $600 a month by combining my boat, my wife's SUV, my truck, because I've got enough equity in my home, and now I've saved $600. Could I in then turn take that $600 and just apply it to principal every month? And in theory, assuming I remain disciplined and don't go buy another boat and truck, but essentially I could also lessen the amount of time left on my mortgage. Is that correct?
You absolutely could. And the tech that we have, our proprietary LOS Nano. It's got so many different tools built out inside to basically help educate the consumer on your refinance scenarios. We even have a latest update as of the last 2 months. It's a should I refi option. So, you come to me as a 6.75 right now that I helped put you in last year. Hey, Trav, thank you so much. We love the house. We're like, payments are getting to us. We gotta alleviate some stress here. So we can look at the should I refi now options, and it'll present to you. It's kind of we have it built out as a no-brainer refi. We've got options for it's kind of up to you. Here's your break even, and we can show you the amortization, right? We can look at what that boat will cost you if you pay that payment and carry that note to term versus refinancing, rolling it all into one, what your new amortizations look like.
That's cool.
Not many homeowners actually ever look at their amortization schedules, right? On their mortgage, I'd say. So being able to utilize the tools that we have within the tech, really, it takes the salesman out of the picture, and it's really just a conversation between a homeowner and a loan officer, and we're just showing you the numbers. Math doesn't lie, and when it makes financial sense for you, that's where the no-brainer comes out, and that's why I truly enjoy the refinances.
Cool. So let me ask another question. So let's say I purchased a year ago, and I know rates have gotten a little bit better. Do you have anything in place that'll contact me? Like do you do anything for your clients that way?
Great question. So we've had a rates have dropped tool for the better part of 15 years now. And I like to call it our Canopy Mortgage bread and butter, just because that's exactly what it is. It's pretty amazing. So you're set up in the system automatically. When we fund your loan, we will notify you when you would benefit from a refinance, right? We set those parameters as to what that benefit would be. Historically, it's been about 0.5% lower for a no cost.
So for instance, if I closed last year at 7%, you're going to email me or notify me when it's 6.5%, and it's not necessarily going to cost me anything out of pocket.
Correct. The only cost that you might have would be an appraisal, and there's a chance that rate might even have a lender credit that would take care of that piece for you. But the rates have dropped piece is something that we use day in and day out, especially when we have rate improvements like we've had in the last 3 weeks. We send out hundreds of those each day. Notifies the client yourself, hey McKay, it looks like you have a 6.75 on your rate. You could drop that to a 6.25 for little or no cost.
Super cool.
We include a link to our instant quote tool. That's something that I have always loved. It's not something new to Canopy. It's not something new to Box. We are, on our consumer direct side, we aren't afraid to post our rates every single day. You can go there, plug in your purchase price or your refinance value, your desired loan amount. You don't have to put in any personal information just to generate today's quotes. That's all included on the Rates Have Dropped email. It's got my direct contact information. There's a good chance I'm going to be picking up the phone and calling you at the same time. But in terms of the automated piece, we do that on the back end.
Okay, but let's say I made a mistake and I didn't use Travis at Box Home Loans for my my purchase, or frankly for my refinance, but I want to be a part of the rate tracker. Can I get signed
question.
up? Can I?
Anyone can sign up to track a specific rate. You can track not only a specific rate, but if you're coming to me and you're saying, Trav, I want a 5.25 for $1,000. That's what I'm willing to pay, but I want to have, a 5.25. I can set you up in our system, rate tracker. It'll automatically email notify you when the rates hit that target, and we can, easily take advantage of that refi for you.
What will inflation do to the overall housing market, interest rate market?
It's a lot to think about in terms of impact it's going to have. Housing, affordability, biggest thing that comes to mind. Again, it's not, when we're talking affordability and housing and inflation, we're not necessarily just talking about your housing payment. We're talking about if you're carrying credit cards or if you have any type of car payments, student loans.
Price of gasoline, price of groceries.
Absolutely. It all comes into play in terms of our overall debt to income ratio. And those are things that we do have to look at. Fannie and Freddie, Ginny, we all have our maximum thresholds, and as inflation increases over time, those balances also increase. And as those balances increase, payments increase. I think that housing is still strong and will remain strong. I think affordability is still there as long as we can live within our means, and we can, it's okay to want new things in life. Totally. I get that. I feel the same way, but we don't always have to have the latest and the greatest, newest car, newest shoes. There's just so many things out there nowadays that people feel that they have to go and spend money on or have. And that will directly impact inflation. If consumers stop buying the wants and only buy the needs, I think inflation will get a little bit more manageable. And we're not immune to costs and goods increasing. They just do over the years. It's kind of what it is. It's like my property tax bill that I got yesterday. I know it's coming every year, but what is the increase this year is kind of the question. And inflation, I look at kind of the same. But what it means to me is how much more of my paycheck I'm able to keep.
Jeff Reeves taught it to me early on when I was originating, and it was, hey, what you qualify for and what you can afford are two entirely different things. And I would say that under the guise of like purchasing a home. But I also think that same principle is true in everything, in the vehicles that you drive, et cetera. What an individual qualifies for versus what they afford. If you can focus on the affordability side of things, then inflation, while it's going to affect you, it will not affect you like the guy that always goes after what he qualifies for rather than what he can afford.
Yeah, as a loan officer, that's kind of, I should say, one of the top questions that I receive, other than what our rate's going to do next week, is, well, I want to get pre-qualified to the max budget. What's the max I qualify for? And I'm happy to tell you that I am, but at the same time, that's where we come in, and as industry professionals, we educate what property taxes look like, what homeowners insurance premiums look like, what a natural gas bill looks like nowadays, or even, your water bill.
Yep.
If you're not watching that kind of stuff, that adds up and creeps up quick.
Yeah, and it's interesting. I haven't really thought, because you're not necessarily a financial advisor. But you are advising individuals on quite possibly their largest transaction that they'll ever do in their lifetime, which is purchasing a home. I just recently went through and did a bunch of continuing education, and I find it interesting. In order to hold a mortgage license, you have to prove that you are financially responsible and sound. And if you are not, then you're liable to lose your license. And so I think it is good to reach out to the right loan officer that will give you good advice on frankly, what you would qualify for versus what you can afford, and counsel you accordingly so that they're not setting you up for financial ruin. And unfortunately, I've seen loan officers that are all about, let's maximize so that I can get the highest commission. Putting the best interest of the borrower first seems to pay dividends in the long run.
It is. You're absolutely spot on there. And the important piece of that too is, you may come to me as the sole borrower on the loan, and that's great. I'll give you a max qualification. In the back of your mind, it's important to have the conversation too of, oh, my spouse works. They help contribute. There's additional income there. Although we're not utilizing that towards the qualification of the loan, we know we're going to be able to make this payment going forward because of this.
One thing I know, because I'm at the corporate office and I see these coming through regular, you got a bunch of lenders hot after you. They want Travis Meihls to come and work for them. So my question for you is, what is keeping you here at Canopy/Box Home Loans?
A lot of that is the people here. As a loan officer, one can say that everyone gets their rates, bond market. I can sell, I can do loans anywhere. But I remember back to the day when I came in and I met you for the first time, and we kicked it off. It was personal, but at the same time, it was a business discussion. And, I get solicited, honestly, it's probably twice a day
daily
from outside lenders.
And I don't blame them for soliciting you.
And
you're amazing LO.
Phone calls, texts, emails. The other day, I got mailed a passport invitation to come, with, I won't say their name out loud, but another local mortgage company on a trip with them. And I overheard one of the accountants the other day. They said, Travis is a lifer. And it kind of got me thinking, I could see myself being here as a lifer. And that's not just because of what I do day to day. I love what I do day to day. I love coming to work. I'm one of the farthest commuters, actually, for the corporate office. And I've got a full at-home setup, and I could work from home. But I enjoy coming in, interacting with not only my team members, but, everyone here just feels like family, as well as it's a great company to work for. And I may get solicited for years to come, but at the end of the day, my answer to each one of them is I'm extremely happy where I'm at. And, I appreciate your interest. I appreciate you reaching out. There's too many layers of Canopy Mortgage that would, ever make me think otherwise.
Love that. Well, thanks. And we count ourselves blessed to have you as part of the team and as a leader. You're just a phenomenal human. And thanks for taking time out of your busy schedule to spend some time with us here on the podcast.
I always appreciate you, McKay, and I appreciate the invite, coming and chatting.
Thanks, my friend.